Imagine waking up one morning and realizing that the money in your bank account is quietly losing value. Not because you spent it, not because you invested badly, but because new money was created out of thin air. No warning, no permission, no vote, just created. This isn't a conspiracy theory, this is exactly what has been happening over the past decade, and especially in the last few years. The United States has printed trillions of dollars, and while it may sound like free money, the reality is far more complex and far more dangerous, because every time new money is created, it changes the value of every dollar that already exists. And that means it changes the value of your savings, your salary, and your future. To understand why this is happening, you need to understand how money is actually created. Most people believe money comes from taxes, or that governments can only spend what they earn. But modern money doesn't work that way. Today, money is created by central banks and financial systems, often digitally with the click of a button. When the government needs to spend more than it collects in taxes, it borrows money. To do that, it issues government bonds. Investors, banks, and institutions buy these bonds. But here's where it gets interesting. The central bank, known as the Federal Reserve, can also buy these bonds. And when it doesn't use existing money. It creates brand new money. This process is called monetary expansion. And in recent years, it has accelerated to levels never seen before in modern history, especially during major crises. In 2008, when the global financial system was collapsing, the Federal Reserve stepped in and created massive amounts of new money to stabilize the economy. Then again, during the pandemic, when businesses shut down and millions lost jobs, trillions more were created. In a very short time, the total money supply exploded. At first, this seemed like the perfect solution. Markets stabilized, businesses survived, people received stimulus checks. The economy avoided complete collapse, but there was a hidden cost. Because when you increase the supply of money rapidly, something else happens. Each individual dollar becomes less scarce, and when something becomes less scarce, it becomes less valuable. This is the foundation of inflation. Inflation isn't just rising prices, it's the declining purchasing power of money. It means your money buys less than it used to. The same amount of money that once bought a full cart of groceries now buys only half. The same salary that once covered rent comfortably now barely keeps up. This isn't an accident, it's a direct consequence of expanding the money supply. But here's where it becomes even more important. The effects of money printing are not evenly distributed. The first recipients of newly created money benefit the most. These are usually governments, large financial institutions, and major corporations. They receive and use the money before prices fully rise. They can buy assets, invest, and expand while the value of money is still relatively high. But by the time the money spreads through the rest of the economy, prices have already increased, and ordinary people are left dealing with the consequences. This creates a hidden transfer of wealth, not through taxes, not through laws, but through the structure of the monetary system itself. This is why asset prices often rise dramatically during periods of heavy money printing. Stock markets surge, real estate becomes more expensive, assets inflate, because the new money flows into financial markets first. Meanwhile, wages don't rise as quickly, savings lose value, and the cost of living increases. This creates the feeling that everything is becoming more expensive, while incomes struggle to keep up. And this isn't just theoretical. It's visible in everyday life. Housing prices have surged, rent has increased, food, energy, and basic necessities cost more than ever before. But money printing doesn't happen randomly. It happens for specific reasons. One of the biggest is government debt. The United States has accumulated massive amounts of debt over decades. To finance spending beyond its tax revenue, it continuously borrows. And the more debt exists, the more pressure there is on the system. Printing money makes managing this debt easier in the short term, because inflation reduces the real value of debt. If money becomes less valuable, the debt becomes easier to repay in real terms. But this comes at the cost of weakening purchasing power for everyone else. Another reason money printing happens is to stimulate economic growth. When central banks create money and inject it into the financial system, it encourages lending and investment. Lower interest rates make borrowing easier. Businesses expand, consumers spend more. This creates the appearance of economic growth, but artificial stimulation can also create bubbles. When too much money flows into markets, asset prices rise beyond their true value. And eventually, corrections happen. This cycle of expansion and correction has repeated throughout financial history. There's another important effect of money printing that many people don't realize. It changes behavior. When people know money is losing value over time, they become less willing to save. Saving becomes less rewarding. Spending becomes more attractive. Investing becomes necessary just to preserve value. This shifts the entire psychology of the economy. It pushes people into riskier assets. It encourages speculation. It changes financial decision-making. And over time, it reshapes the structure of society itself. But here's the paradox. Money printing can prevent economic collapse in the short term. Without it, financial crises could be far worse, banks could fail, businesses could collapse, unemployment could skyrocket. So central banks face a difficult balance. Print too little and risk collapse. Print too much and risk inflation and instability. And this balance becomes harder to maintain as debt increases and economies become more dependent on liquidity. There's also a global dimension to this. The US dollar isn't just America's currency, it's the world's reserve currency. It's used in international trade, it's held by governments worldwide, it's the backbone of the global financial system. This gives the United States unique power, because it can create money that is used globally, but it also creates global consequences. When the US prints money, it affects exchange rates, trade balances, and economies around the world. Some countries benefit, others suffer, and the ripple effects extend far beyond national borders. But despite all of this, money printing continues, because the modern financial system relies on it. Debt-based systems require expansion, growth requires liquidity, and stability often requires intervention. This raises an important question. If money can be created so easily, what gives it value? The answer is trust. Money has value because people believe it has value, because they believe others will accept it, because they trust the system behind it. This trust is reinforced by governments, institutions, and economic stability. But trust can also be fragile. If people lose confidence in money, its value can decline rapidly. This has happened throughout history. Currencies have collapsed. Inflation has spiraled. Systems have reset. But these events don't happen overnight. They happen gradually, through small changes, through accumulated effects, through shifts in perception, and often most people don't notice until the effects are already significant. So what does all of this mean for you? It means understanding that money is not static. Its value changes, its purchasing power evolves, its role shifts. It means recognizing that saving alone may not preserve value over long periods. It means understanding how economic forces shape financial outcomes, because the system affects everyone, not just governments, not just institutions, but individuals, workers, families, savers, investors, everyone. Money printing is not inherently good or bad. It's a tool, a powerful tool, one that can stabilize economies, or create imbalances, one that can prevent collapse, or contribute to inflation. The outcome depends on how it is used, how much is created, and how the system responds. But one thing is certain. The creation of trillions of dollars is not without consequences. It changes the economy, it changes markets, and it changes the value of money itself. And while most people never see it happening directly, they feel its effects every day, in prices, in costs, in opportunities, and in the silent transformation of the financial world around them. Because in the end, money is more than just numbers. It's a system, a structure, a reflection of trust, power, and stability. And understanding how it works is no longer optional, it's essential, because the future of money is being shaped right now. And whether people realize it or not, they are already part of it. But there is one more layer to this story that most people never see. Money printing doesn't just affect prices, it affects time. Specifically, it affects how your work today translates into value tomorrow. When you work, you are essentially converting your time, energy, and skills into money. That money represents stored value. It represents hours of your life saved for future use. But when new money is created rapidly, the value of that stored time begins to erode. They either avoid risk completely or chase higher returns to outrun inflation. Both reactions reshape the economy. Because ultimately money printing doesn't just change numbers, it changes incentives, it changes decisions, and it changes the future. Not through force, but through influence, quietly, gradually, and continuously. And the people who understand the system early are often the ones best prepared for what comes next.